So we are moving on to chapter 8, and we're going to talk about rental income, royalties, and income from flow-through entities or pass-through entities. It could be known as either one. All of this income is reported on our next schedule, Schedule E. Okay, so we've got a whole new schedule that we're going to look at. Okay. This particular chapter is going to incorporate a lot of the information that you already know from chapter 6. Okay, because rental properties is what we're mostly focusing on here. Royalties is a very tiny little topic in this chapter. Flow-through entities isn't all that complicated either. As far as flow-through entities are complicated when you are actually filing the tax returns for them. They can be complicated, but when you're reporting the income that an owner receives from them, it's not quite as complex. But so most of our time is going to be spent talking about rental properties, and rental properties, because it's a business, we're going to talk about a lot of the same things that we talked about with regard to ordinary and necessary business expenses and how we report income from that, from those rentals. And of course, because there are assets involved in rental activities, mainly whatever rental property you have, that's going to be the asset, we have to depreciate it. Okay, so these are things that we have already gone through, so a lot of it's going to be, it shouldn't be too much to take in. So these are our learning objectives here. We're going to talk about how that the income and expenses are recognized and how they're reported on the Schedule E for rental properties. Now, one nuance well, there are a couple of nuances to rental properties. One is that a rental property, well, a piece of real estate could be partially used for rental and could be partially used for some other purpose. So, for example, if you have a duplex, you could live in half of the duplex and rent out the other half of the duplex. If you have, say you've got a triplex and you live in 1/3 of it, you rent out 1/3 of it as a residential, and then you rent out the other third of it, or you use the other third for your personal office. So it could be multi-use. Okay, so that's one of the nuances that we've got to figure out, okay, how do we report then the portion that is attributable to rental property? Because rental property, obviously, because it's rental property, it's a business, which means the ordinary necessary expenses associated with it are deductible. Personal property, personal use property, is not associated with the business, and most of those expenses, aside from mortgage interest and property taxes, aren't deductible. And then, if you're using the other part for a business, you're talking about expenses that would be associated with the Schedule C business, and everything that would go on that particular form. Okay, so that can get a little bit complex when you've got one property that is used for multiple purposes. So we're going to go through kind of how that allocation works, and because we've gone through that business use of home allocation, that's a type of allocation as well. You kind of already you probably can already figure out intuitively, okay, we're probably just going to take, the business portion, we've got to multiply it by whatever square footage percentage and apply that to our rental, and then the rest to personal and whatever other uses we're having. So you should be able to grasp onto that pretty quickly. The other nuance though with rental properties is not only could it be partially used, maybe it's used 100% of the time, and it's split up for different uses during that whole time. It could also be, the time could also be split up. So you have a rental property that you rent out some of the time, but you use it personally some of the time as well. Vacation homes are a good example of that. So if you have a vacation home, but when you're not using it, you rent it out to somebody, maybe it's an Airbnb or whatever that other VRBO. How do we allocate then the expenses that are associated with that property. And is it even a business? Is it, do we use it enough as a vacation property to call it a business, or is it all personal? So there is that nuance as well. So these properties, again, could be multiple use, or the same property could be used for different purposes during the year, right? So those are two of probably the more complex nuances with regard to rental properties. Then, like I said, we're going to look at royalty income. Royalties are payments for the use of some sort of intangible resource or intangible asset. We mostly see royalties, we see royalties a lot with like oil and gas extraction. You can invest in oil and gas companies, and when they make money, what you receive are called royalties. It's an intangible because it's your right to that property. It's not the actual land that you have, it's a right to the profits in that land. So royalties are rights to intangible, in some type of intangible asset or income.
Music.
What's that?
Music has royalties as well.
What's that?
Music.
Music royalties, literary royalties, absolutely. And there are some nuances with that just because, so all of the income that we're talking about in this chapter is not self-employment income, which means it's not subject to self-employment tax, right? Rental income is not subject to self-employment tax. That's why it's also critical that you are able to allocate properly to each type of activity, because, like I said, if you partially use it for a Schedule C business, that same property, you want to make sure that you are grasping all of the allowable expenses there, because that's going to offset a higher tax rate, right? So, and when we're talking about music and literary and art and stuff like that, there's a very fine line between, is it a royalty or is it business income? Because if it's something that you produced, it gets a little bit fuzzy on what you do with that. The last type of income that we're going to talk about that goes on the Schedule E is income from flow-through or pass-through entities. So you'll hear me use both of those. Probably hear me say pass-through more than flow-through. They're the same thing. So exactly the same thing. Pass-through, flow-through entities. These are entities like partnerships, S corporations, trusts, and estates. Now, they include LLCs here. When we get to this section, I'll tell you why it kind of annoys me that they include LLCs here. LLCs aren't tax entities, they're legal entities. But a lot of people are very familiar with that term LLC, so I think that's probably why they put this in here. But these types of entities report their income on a separate tax return. They have their own tax return. So like partnerships use a form 1065 instead of a 1040. They use a 1065 to report their income and expenses. S corporations, and we're going to talk more about those in chapter 15, use a form called 1120S. They're a special type of corporation, usually smaller corporations, but they're still a corporation, which means they have stock that usually the stock really isn't for sale, though, to anybody other than the immediate owners. And then we have corporations, which report on form 1120. Now, these two are flow-through entities, which means the income, they have their own tax return, they report the income and expenses on that tax return, but they don't actually pay any income tax. What happens is the income, the net income or loss that results from the activities within each of these entities flows through or passes through to the owners of that entity. And then the owners report the income on their own personal tax return. Which means you have situations where if you have multiple owners at different tax rates, the exact same income is being taxed at different tax rates, right? So, Andrew and Anissa and I own a partnership together, and Andrew owns 50%, I own 10%, and Anissa owns 40%. Oh, that's not a 4. 40%. And our partnership, we'll say it's a partnership instead of an S corp, doesn't really matter, either one. Our partnership has income of $100,000. Well, Andrew is in the 28% tax bracket. I am in the 22% tax bracket. And Anissa is in the 37% tax bracket. That income is going to get divided up between us based upon our ownership percentage. So, Andrew, you're going to report $50,000 of income, which is going to be taxed at your tax rate of 28%. I'm going to report $10,000 of income, which is going to be taxed at my tax rate of 10%. So I'm going to pay $1,000 on my $10,000 of income. You are going to pay, what is that, $600 on, is that right?
Yeah.
No, more than that, isn't it? 28 times 2 is 56, yeah, $5,600 of tax on your $50,000 of income. Anissa is going to report income of $40,000, and he's going to pay 37% on that. Same income came from the same entity, but it's going to be taxed at different tax rates because it flows through to our individual tax returns. Once that tax return gets filed at the entity level, we are issued a report, it's called a K-1, we'll get into that a little bit more, that shows our portion of all of those income and expense items. Okay? So that's what a pass-through entity is. So what we're going to talk about here is from the owner's perspective, not from the entity's perspective, but from the owner's perspective, how do we report this income on our tax return? Here. When we get to chapters 14 and 15, we're going to talk about how these entities report those income and expenses. Okay, but we're not going to get to that quite yet. Questions so far? Go ahead. I want to pull up a Schedule E so you can see it. I'll keep this going for you now. You'll see that the Schedule E looks, it's just like another income statement. Let's see. That. Is there Schedule E up here? Yeah. Okay, cool. So Schedule E has, well, there's lots of different information on here. It has space for all of those types of income. There's a page 2 of it. Okay, page 2 is where we report that income from our flow-through entities. Page 1 is where we report our income and expenses from our rental income and our royalties. Okay, so part 1, they want information about what type of entity is this. So if it has a physical address, meaning it's a rental property, they want the physical address of it. They ask the question again about the 1099 forms. The IRS really wants you to file those 1099 forms if you have to. Again, you'd either check no here and then nothing here, or yes and yes. You should never check yes and no. Yes, I'm supposed to do it, and no, I'm not going to. No, make me. They don't like that. This part here, so each of these rows then corresponds to other rows further down. So we've got a rental property here in San Clemente, California. Type of property, stop. Type of property, there's a number here. There's a list down here of the types of property, the categories. Single family residence, multifamily residence, vacation, short-term rental, commercial property that's rented, land. People rent land. Farmers rent land a lot. Actually, farm rental has a separate form as well though. Royalties, self-rental, which is essentially you own a business and you own the building. They are separate businesses. The building is renting your business the space. This is how professionals become wealthy. It's not from actually practicing in their professions. It's from buying, a lot of them, from buying real estate and then paying themselves rent in order to use that real estate. So then we come down to, so once we've clicked off the type of property, over here, rental days, personal use days, so that comes into play when we're talking about dividing up between those two. This QJV, this means qualified joint venture. So remember I said that anytime two or more people go into business together, they're automatically a partnership. They may choose at some point to become a corporation, but if they don't make any choice like that, they are just a partnership. And they would have to file a partnership return. They'd have to file a separate partnership return. That still holds if it's a married couple, because they're two people and they own a business together. Well, they give you an out on rentals, because what oftentimes happens, of course, is it's a married couple that owns the same property. And then to file a partnership return for that is a royal pain. So you can elect to be called a qualified joint venture so that you don't have to file a partnership return. It does mean, though, that all of the income and expenses have to be divided between those two. It's still a partnership. So the husband would have or one spouse would have a Schedule E for half of the income and expenses. The other spouse would have a Schedule E for the other half of the income and expenses. But this saves them from having to file that partnership return. Partnership returns as well can be very expensive to file. You know, it's a much higher level of service that accountants provide. So if you're interested in tax and you want to make more money, become versed in partnerships and corporations. Estates and trusts are pretty good too. Trusts are really great because if somebody has to, well, trusts are good. Estates are really good, I should say. Because if somebody has to file an estate tax return, it means they have a lot of money. Because most people don't have to file an estate tax return. Most people aren't hip with estate taxes, but they're very expensive to prepare. So just kind of a FYI there if you're looking at future employment opportunities. Okay, so each of these rows, and of course, if we have more than 3, that means we're going to add additional Schedule E's onto this. So each row up here pertains to the rows down here. Okay. And then each of those rows pertains to a column here. This is the income statement part. So you'll see, there we go. Up at the top, rents received or royalties. So if it's a rental property, like it is here, column A, it's just going to have rents there. Maybe our second item here, B, maybe we have royalties as well. So we would indicate royalties. In here, for B, we put number 6. And then the income from our royalties would go in column B. Okay? But in this case, we only have one property. It's a rental property. Income, rents received, go up here. You'll see a lot of these look familiar, right? A lot of these categories are very familiar, similar to the expense categories that we had on the Schedule C. Some of them are a little bit different though. So we didn't have management fees listed specifically on the Schedule C. That doesn't mean that we wouldn't necessarily have management fees for something on the Schedule C, but management fees are very common with regard to rental income, because oftentimes people will have, it's passive income. They have a property, it's just sitting there, they rent it, they don't want to take care of it, so they hire somebody else to take care of it for them, right? Hire somebody else when a problem arises, and they always arise with rental properties. When a problem arises, they can call the management company instead of involving the owner. So management fees are very common. Insurance, cleaning and maintenance, it's another one. But a lot of these are very, very similar. Mortgage interest. So before we had just interest, and mortgage was a separate category of interest. This one we've got mortgage interest actually specifically delineated here, because the mortgage interest would be deductible as a rental expense if you borrowed in order to purchase the property. Taxes, utilities, repairs, depreciation. So we've got that again as well. and then we get down to our totals. Now the reason we have 3 columns here is because this is passive income. It's not active income. It's passive. We are investing in it. We're really not doing anything, right? We've given our money. We're sitting back and letting our money work for us, hopefully. There are special rules for passive income, and there are certain ways that you can combine income and loss from passive activities. That's why we're putting them all in the same form, and ultimately why we're netting them all together. Now we're not going to go through the netting nightmare that we did with capital gains for these. We don't cover, there's a chapter in your book, chapter 13, that talks about passive income and losses. We don't cover that chapter in this class. You're welcome. It's complex. But that's why we've got the 3 columns, and that's why it's all on one form here, is kind of why I wanted to say that. And all of it is combined to a net income or loss, real estate royalty income or loss on the bottom line. Obviously, the 4562 comes into play, again, because we're going to depreciate property. We've got a building. We may have other assets as well. We probably have other assets as well, so we're going to have depreciation that we have to deal with. So that's what this form is here. Remember, so this in this example, it's a residential rental, so it's 27.5-year life. They purchased it this year, but they've got some other types of property as well. We're going to go through and talk about why those might be separated out here. This, well, that's page 2 of the 4562. You're familiar with that. I don't know if they have, what else do I want to say? Okay, so that's the Schedule E. Now, let's get into some of the details about this stuff.